camera tonight. Hope everyone is doing really well. Thank you guys so much for checking us out. I'm just trying to get centered in this camera. I think you guys can hear me and see me okay. Hey, good evening everyone. I hope you're doing good. It's Angelo Christian Live every Thursday, 7 p.m. Central. We do a talk with Angelo Live where I come on the show, talk about all different types of things, and with respect to finance, the markets, credit, and it's an open forum. You guys can ask me any questions that you want, with regards to lending. I know I talk about a lot of things that I'm seeing that's going on in the market in the world right now. We are a direct lender. We're a nationwide lender, so you can always reach out to us. You can call or text our office at 832-431-6331. I've been actively lending in America for 20 years. Hey, Sandra, good evening. I hope you're doing well. Thank you so much for checking us out. We got a lot of good stuff to talk about tonight. Big topics that I want to talk about tonight is when you're buying real estate, should you lock or float your interest rate? That's a big topic I want to talk about tonight. The other thing is that should you, in a seller's market, the second thing I want to talk about is should you be waiving appraisal and financing contingencies? Should you be waiving these contingencies that are very important when buying a home? That's a big thing I want to talk about tonight. The third thing is what to look out for when transferring jobs. Good evening, everyone. I hope you're doing well. Thank you so much for watching the show. That's a big thing. What to look out for when transferring jobs. If you're transferring jobs, what do you need to look out for when you're trying to get a loan? These are important topics. And the last thing I want to talk about is the non-QM, the non-qualified market. That mortgage market is exploding. And I want to talk about some of the things I'm seeing with the non-QM real estate mortgage lending space because it's getting hotter and hotter. I think it's very important to bring that up. Hey, Lakeisha, good evening. I hope you're doing well. Thank you you guys for everyone watching the show. I appreciate you guys for all your support. We value our fans, our followers, our clients very deeply. So, like I said, I've been, a nationwide commercial residential lender for nearly 20 years and helped tens of thousands of people. So I appreciate everyone watching the show. Remember, every Thursday, 7 p.m. Central, we do a free Amazon giveaway for a gift card to our lucky winner. We'll ask them a question, and if they answer that question right, they'll get that free gift card. So kind of a little perk to kind of hook everyone up, a free Amazon gift card. Everyone loves Amazon. It's one of my favorite stores. So just something, a little value add that we do. But anyway, hey, what's up, blogging? How are you? My wife is starting a new job on the 1st of the month. How long should she wait? Great question. That's a great question. And that's one of the things that we were talking about is getting a new job. How does that affect you? Hey, good evening, blogger. So thank you so much for watching the show. So, we can start with that because I think it's an important topic to kind of discuss. So the thing is, guys, when you're trying to get a new job, and you're transferring from one job to another, it's a really big deal in lending when you're trying to get a loan because, let's face it, for conventional loans, FHA loans, VA loans, USDA loans. Hey, good evening, Anthony. Good evening. I hope you're doing well. Good to see you. So the thing is that employment, you have to have income. And lenders, they look back generally historically 2 years to determine your income qualification. And if you're going to a new job, you left one job, you're going to a new job, that could potentially throw a wrench or have some concerns to your lender. Why is that? Well, because you started a new job and they don't know, what your pay is going to be, your tenure with the company, are you going to last there? There's a lot of stuff that could potentially change, and a lot of lenders, they don't feel comfortable with that. But I'm going to talk to you about some of the guidelines and some of the requirements if you are changing jobs or thinking about it. What I can tell you is a few things. So if you're first off, staying in the same industry, and now you're going to a new employer. So if you're on hourly pay and you're starting with a new company, you have to be employed with that company for at least ideally a month before you can close on the loan. So if you're let's say you're in the oil and gas industry, you're getting paid $20 an hour, and then you go to work for a new company, new oil and gas company, and you're getting paid $20 an hour, then that's okay. but you may have to be at that new job. You might have to get at least one pay stub from the new job. You might have to be on a job at least a month before the underwriter will let you close because they want to make sure you're going to keep your job. Hey, John, good evening. Pension factor. I'm going to talk about military pension. I'll bring up military pension. I'm glad you brought that up. So I'm just writing that down real quick. So the thing is that if you're on salary, then you could be on a salary and then start a new company, and you can start that job. What's the maximum income? I'll talk about that, Kenya. Thank you. Max income for a first-time buyer. So, so great question. So the thing is that if you're on a salary, you can generally have at least one pay stub or an offer letter, and you can close on that loan on that house. Okay. Now, if you're transferring and you're staying in the same company, let's say you're moving from San Diego to Dallas, right? And you're staying with the same company. I'll talk about the HELOC. Great question, Anthony. I'll talk about HELOC. So if you're transferring from the same company, let's say that you work for Caterpillar in San Diego and you're coming to Houston or Dallas to Caterpillar, then that's okay. You don't have to wait. You just get a transfer letter stating that from your employer that that you're transferring and everything's the same, you'll be fine. If something's changing within the company and you're staying with Caterpillar, then you may need to have a few pay stubs before you can close. Okay, and this pretty much goes for all different types of loans. I'm doing a very generalization, all different types of loans. Now, I will tell you that if you're changing employment, the composition of your employment, let's say that you're, hey Bobby, good evening. I hope you're doing good. Thank you. Thank you so much for coming back. Hope you're doing great. So if you're changing from a W-2 employee, I'll give you an example, to a self-employed, it's gonna be a little bit of a problem. All right, I had a client that recently was in Florida and he wanted to buy a multi-family property, and he made great income, like $110,000 a year income. And he wanted to buy a multi-family. He was in Orlando, moving to West Palm. And so, but he became self-employed during the process after he got pre-approved, and he wanted to still buy the multi-family. And so the thing is, the issue is because he was W-2 employee when he got approved, and now he just became self-employed, he would have to wait how long? 2 years before he'd be eligible to buy a home, because he changed from a W-2 employee to self-employed. So you'd have to be 2 years on the job if you're changing from self-employed to W-2 employee to self-employed. So be mindful of that, because if you're changing employment composition and you're becoming self-employed, you have to be self-employed for at least 2 years before you can get a loan. Okay? So that's a very, very important thing to think about, because a lot of people are not aware of this. Oh, I thought I could get a loan. I just started as self-employed, 1099. I can get a loan next month. It doesn't work like that. Unless you're doing private loans and stuff like that, regular loans, it will not work. So that's basically the down low, the scoop on transferring jobs. So everyone got it. If you're hourly, at least first pay stub to 30 days, salary, offer letter, or first pay stub. Transferring jobs, stay with the same employer, you're good. If you work remote, then you just need usually just a letter from HR stating that you're approved to work remote, and you don't need to do anything. A lot of time right now in COVID, a lot of employers will let their people work remote. If you're working remote, it's fine. It doesn't matter. So, so that's the down low. Oh, your wife is changing from supervisor manager to general manager. Okay, is she getting paid hourly or salary? That's the question I have. And is she getting an offer letter? These are things that we have to know. Is she getting an offer letter? Is she changing from hourly, salary? Those type of things. If I know that, then I can tell you what you need to do. Okay. So that's the one thing. Okay. So I want to go to some of the questions. That's fine, right? It depends. It is fine, but I need to know more information. Remember, with lending, there's a lot of details. There's a lot of information that we have to do to make it right. Okay, so the one person asked in the thread about military pension. If you're doing a VA loan or you have military income, and that income is not taxed, you can gross up that income. So that was the answer to the question for a gentleman that asked earlier about military income. Let's say that you make $1,000 a month on military VA income. Then she's salaried, then okay, then all you need is just an offer letter, and you should be good to get a loan approval. You just need an offer letter, okay? And maybe they may want her to work a couple weeks, but generally just an offer letter. What about returning to self-employed? Well, it depends if you're a self-employed prior, Lakeisha. If you just started being self-employed, then you have to have 2 years. If you had a previous history, like 1 year self-employed, you need another year. It just depends. You have to have 2 years total work history, self-employed. So military income, you can gross up by 15%. So what I mean by that, that means if you get $1,000 of VA income, you can gross that up to $1,150 a month, 15% to qualify for your loan. So you add 15% because it's non-taxed. So whatever your amount is, let's say it's $1,000 a month, you add 15% of that to make it non-taxed, and then you go to $1,150 per month. That's what you can use for the basis of your qualification for VA military income. Bobby, we don't have an office in Reno. We lend in Nevada. Versus disability, same thing with disability too. Any non-taxable income can be grossed up by a minimum of 15%. So whatever you're getting, add 15% of that, and that's what you can put on your application for your income. Bobby, we do lend in Nevada all day long. Love Vegas. Call or text us at 832-431-6331 if you need a loan. That's why we're here. Then somebody asked another question. Okay, you both work. Somebody asked, what is the maximum income limit for first-time buyers? So first-time buyer programs that are out there that are prevalent is FHA, USDA, conventional loans, even VA. And so basically for the traditional FHA, traditional USDA, and even conventional first-time buyer, there's a conventional first-time buyer, you just need 3% down. You don't need 20% down. Your income, it depends on how many people live in the house. Usually 1 to 4, your income has to be below, let's just say $90,000 a year for 1 to 4 family, or 1 to 4 people. If you have more than 4 people living in the home, you have 5 people, 6 people, your income can usually go up to about $120,000 a year. So what does this mean? That means that this is the income limitations that you can have when getting these type of loans, and you want down payment assistance. So let's say you do an FHA first-time buyer and you have 3 people living in your house. It's based on your county. Your county will tell you what the income limit is, but generally let's just say it's $85,000 to $90,000. Your income has to be below $90,000 to get that down payment assistance. If it's over $90,000, you cannot get the down payment assistance. You have to put your own 3.5% down in this example, okay? Now let's say you have 6 people living in your house and your income's $112,000 and the income county limit's $120,000. Can you get down payment assistance? Yes, the answer is yes, you can. There is, that's what we're talking about right now, Blogging Trucker, is the programs for down payment assistance. There's FHA, there's conventional. New York, that might be a little tough in New York to get down payment assistance. I know there's FHA, and normally, with most loans, you need 10% down. We have an FHA first-time buyer, you only need 3.5% down that we can help you with on that. So, but that's how it works for the income limitation for first-time buyers, okay? Now, somebody asked about what is a HELOC. A HELOC is actually one of my favorite loan programs. I did a few of them today for some of my clients. Basically, a HELOC is a line of credit. So you've seen us talk about first lien HELOCs, replacing your mortgage with a HELOC. I'm a big advocate, a big proponent. Well, thank you, Bobby. I appreciate that. I don't know. I think you guys are smart. You guys are getting smart by watching the show. So, so a HELOC is a line of credit. Okay, like if you think about a credit card, like your credit card that you have in your wallet or your purse, that's considered a revolving line of credit. So like if you go to the store and you charge up $100, well, you spend $100 and now you have $100 against your credit card. Now, if you pay down the credit card by $100, you have all that available credit, the $100 available. And you can keep doing that back and forth, as long as you make your payment on time, the lender or the creditor will keep the account open. Well, that's what a HELOC is. A HELOC is like a credit card, right? It's revolving like a credit card. What kind of rates for what, Anthony? What type of it? Hard money and first-time buyer, Don, those you wouldn't want to mix those. Hard money and first-time buyer do not mix. That's not a good idea. Oh, the rates on the HELOC start at. No, I'm going to go into that. I'm going to go into the rates. So the thing is that instead of having a mortgage and paying your payment every single month, $1,000 a month, you can never get that money back when you pay into a mortgage. I pay $1,000 a month, I pay $1,000 a month. For 10 years, I paid $1,000 a month. Only way you can get that money back is if you sell or you do a whole refinance. You just can't, hey, pick up the phone, give me my money back. It doesn't work like that. So, cool, Bobby. So a line of credit is the exact opposite of a mortgage. That's why we say get rid of your mortgage, you get a HELOC, because the HELOC is just like your credit card. Okay, you paid in $1,000, you paid in $10,000 over 3 years, you paid in $100,000 over 5 years. You can pull that money right back out. Let's say you want to pull that money out for investments. You know, let's say that you found another property you want to buy and you have $200,000 on your HELOC. You can take that money out. Let's say you want to build a house. I had a client the other day, she wanted to build a new house. So she did a HELOC loan, right? She had a house that she owned free and clear, pulled $600,000 out, going to go build a new house with it, right? She's going to manage her own draws, smart thinking, right? So you know, HELOCs are really good. There are qualifications for the HELOCs that you have to have at least a 660 credit score. We have to verify your income. There's no hard money allowed. It's not a no-doc loan. It's a fully documented loan with 2 years of income. Debt ratio maxed at 45%. Interest rates on that are starting at 4.5%. But it's not like a regular mortgage loan. So don't think, oh, that's a high rate. It's not a high rate because you're only doing interest only. You're only paying interest only. There's no mortgage insurance and there's no escrow required. So your payment is going to be much cheaper on a HELOC than it ever will be on a mortgage because you're just doing interest only. Now you can pay principal and interest, or you can pay as much as you want towards the principal, but you have this awesome opportunity to really cash flow and make a lot of money in investments with a HELOC. So obviously it's based on your credit and everything like that as far as the interest rate you're going to get, but I will say they do start at 4.5%, but a phenomenal product. Highly recommend thinking about a HELOC as a great program. So, and that actually leads me into one of the things that I wanted to talk about tonight. Yeah, HELOCs are great. HELOC is a great program. A lot of my clients, they do them all the time. The one thing that I did want to talk about tonight was also, you know, a lot of people don't know when they're getting a mortgage what the difference between locking and floating is. I'm going to do a podcast on this because when you're getting a loan, that interest rate is not locked in when you apply for the loan, okay? That loan is floating. I'm going to talk about what that means because a lot of people aren't aware of, you know, that interest rates change every day. Actually, surprisingly, a lot of people don't know this. Interest rates change all the time, right? Just like gas prices, just like steel prices, like lumber prices, they change every day, right? So you're not going to, will under the table loans be counted in my DTI? You always got some interesting questions, Bobby. It depends. I mean, you know, obviously they don't do background checks. No, not on residential loans. On commercial loans, they could do background checks. So under the table loans, I don't know. I mean, if it doesn't show up on credit, usually, yes, the HELOC is variable. It changes monthly with the Treasury, the United States Treasury, so it's very stable interest rates. It's not crazy. It's attached to the federal government, Treasury. So the debts that we're going to find are the debts that you have on credit. You know, that's what we're going to find. So if you don't have that debt, we're not going to know about it. So we'll talk about hard money loans. I have a lot of videos on hard money loans. We'll talk about that, Don. The term is it's a better. I have 1.3 rentals looking for cash out. Yes, we can definitely help you on cash out on rentals up to 75% loan to value. Call or text me at 832-431-6331. The term is a 20-year term on the HELOC. I have a lot of videos on that HELOC. You can watch those videos, okay? So anyway, locking versus floating, what does it mean? When you get a mortgage loan, the rate's not locked. Okay, so when the guy quotes you 4%, no, the HELOCs go up to 90%. The investment cash out goes to 75% loan to value. Yeah, so locking versus floating, when you're getting that loan and the loan officer says, hey, your rate's 3%, that doesn't mean you're going to get that rate. It's not locked in. That rate's floating. When you sign your loan disclosures, that rate's not locked. You may have saw 3% on the disclosures, but that's not your final interest rate. The interest rates change all the time, and if your loan's taking a long time to close, that rate could go up or down. Thankfully for everybody, rates have gone down in the last 2 months, but they were higher back in late March, early April. Thank you, Bobby. I appreciate you, man. So the thing is that, why am I bringing this up? Because you need to be aware when you're getting a mortgage that when's the time to lock your rate. So you want to be thinking about locking your interest rate. You obviously want to be paying attention to what's going on in the stock market and to what's going on in the bond market. Okay. Now you might not have time to watch all that, but basically you need to get with your lender and tell them, look, what are the rates doing, and I want to lock my rate. And usually rate locks are good for 30 days. So normally you have to wait until you get closer to closing to lock your interest rate, because VA loans, John, can take about 30 to 40 days to close. That's a good question. But basically, you want to get with your lender to make sure that he's locked your interest rate. Usually after you sign your disclosures or you get your appraisal in, and you want to kind of go talk to him about what rate you want, because usually they can send you over pricing of what's going on in the market that day and send you 4 or 5 rates to pick from. Don't let them just give you any rate that they want to. Say, look, what are the rates at? Send me the pricing. And then you can pick what rate you want, whether you want to pay points, whether you want lender credits or whatever. You get to choose what that is. Hey, Sherry's, good evening. How are you? So you get to choose what that is, okay? So, and you want to lock that interest rate in, because what you don't want to do is ride it all out and put all the money on red, and you turn out that you're wrong. You want to lock in that rate sooner than later, because rates change, they could go up. Rates on cash outs, it depends. I mean, that could depend. They start at 3.25%. It could go up from there. All depends on many variables. So it depends. Can you verify your income? What type of properties are they? And there's a lot of stuff that goes into them for us to really know for sure what the rate's going to be. What's the loan to value, the stake, and can you document your income? Are they primary? Are they rental? Once I know that, I can kind of quote you on what the pricing is going to look like, okay? So, but at some point, know the difference between locking and floating. Talk to your lender. Hey, is my rate locked? Is it floated? I want to lock my rate sooner than later, you see, because you want to make sure that you're just not blindly going into it and then you don't even know your rate's locked, and then all of a sudden, well, they quoted you 3%, or you got 4%. Oh, I didn't know I had to lock my rate. Well, that's not how it works. You have to lock your rate. You got to be aware of it, because it is your lender's job to tell you about it. You cannot, unfortunately, do a HELOC on an investment property. It has to be a primary, unfortunately, right now. So that could change in the future, but as of right now, it has to be a primary residence, okay? So that's, yeah, that's a good name. So now, the other thing I want to talk about is, this is coming up a lot. I'm seeing a lot of YouTubers, a lot of lenders are talking about this, a lot of brokers, about waiving contingencies. I'm going to talk about that because I think it's an important topic to bring up in the market right now. So right now, the market's hotter than heck, right? Sellers, they can pretty much do whatever they want. That's at least how it seems. So one of the things that the realtors have gotten really crafty at, and I'm not a big fan of it, but it's a reality, it's here, is basically making you the buyer if you are a buyer, and you may be a seller watching this too, but I got to talk about what I'm seeing because it's not really 100% legit in my opinion. So basically, they're having the buyers waive all the contingencies on financing. I had a customer in California, he's buying a $900,000 house this week, and the realtor is making him put $30,000 money up front and waiving all the appraisal and financing contingencies. And the thing is, I want you to think about, what does that mean, right? What does that mean if you're waiving all the contingencies and you put up all this money? So basically, that means that if your loan falls through, or the property doesn't appraise, you're screwed, right? You got to close on that deal no matter what, or you lose your earnest money, right? Because if you waive all of your contingencies, and that's what maybe some agents may get you to do, you have to understand, what does that mean? That means if you put up that earnest money and for whatever reason the loan doesn't go through or the appraisal falls short, you have to perform, you have to close on that loan, or you will lose your earnest money. Now, normally that's not how it works in the market. Normally, in a normal market, you have financing and appraisal contingencies in place. That means if you can't get the loan, your earnest money that you put up is refunded to you. And if their house doesn't appraise, no problem. We can negotiate it, or maybe the seller can drop the price, or you can walk out and get your earnest money. Now, that's not happening right now, generally speaking, because the sellers are getting multiple offers. They're getting cash offers, and they're like, "Look, I don't need to put up with that. I don't need to deal with whether you get a loan or I don't care." That's how sellers are talking. So I'm just bringing this up because I don't really like it. It doesn't seem fair to people that are trying to buy a house. It puts them in a corner. Like my client earlier in the week. If he wants the house, he's got to put up 30 G's and hope for the best. And that's not a good position to be in, but it is a position. The thing that keep the 30K, yeah. Well, he's like, well, the thing is that some people are in different spots. Like he's in an apartment, he's got to get out. He can't. His wife is telling him no more. Got to get a house. Yada yada yada. He's got kids. So everyone's in a different situation. His is more needs based. So. But my thing is that, you guys just be careful out there and say, I love hearing Angelo's. Thank you, Cherries. I appreciate that. Thank you. So the thing is that what I'm telling you is just be careful. If you're out there trying to buy a house and they say, hey, you got to waive all your contingencies, tell them, I don't want to do that. I need protection. You're my realtor. You're supposed to protect me for financing and appraisal. Right? So what if something happens? And what I do think what's going to happen is, with a lot of these foreclosures that are fixing to hit the market this summer, you may see more inventory, and you might see the seller's market kind of cool off and kind of normalize, levelize a little bit. So then that way, things can make sense. Because it doesn't make sense. I had a client in California, in Orange County, that was buying $1 million property. And the property, she waived all of her contingencies to get the house, and the property appraised at $900,000. So she's paying $1 million, appraised at $900,000, so she's short. What? $100,000. So she put up $50,000 earnest money. So the options at this point is walk away, lose the $50,000, or you're going to have to cover the gap of the other $100,000 and make that up. Plus pay your down payment, plus pay your closing costs. So it puts you in a very precarious spot. And what I'm trying to tell you is, the takeaway is just make sure that you have your contingencies in place, is what I'm trying to tell you. Dump the wife and leave the kids. Yeah, there might, I don't know. No, mobile homes are tough. It is crazy market. It is a crazy. Mobile homes are kind of tough. It depends. If it's like 200,000, 300,000 plus, and you're putting 10% down as possible. Mobile homes are kind of tough to lend on, though. If it's a bigger one, like I've done some big ones, like 500,000 and 700,000. Get my foot in the door, a condo, 15-year fix, stay a couple years, and then buy a house. Yeah, you could do that. That's a good idea, Don. Build your portfolio. I think it's a great idea to build a real estate portfolio, to lease out properties and make money. We have a lot of clients that do that. You've seen them on our show. A lot of clients make money building their portfolio with real estate. So I think it's a great idea. But we talked about locking versus floating, contingencies. Oh, the other thing I want to talk about is the non-QM. The non-QM is a non-qualified mortgage. I want to talk about that because I think it's an important topic to bring up. So it's basically, alternative lending, right? Not conventional lending. And it's heating up big time. And I think it's exploding. And I think in the next, decade, a lot of people are going to go to a non-qualified type mortgage and get away from conventional financing because, a lot of bank financing, a lot of conventional loans, Fannie Mae loans, they're hard to get. They're very hard to get. It's not easy. You have to have immaculate credit. You have to have, low debt ratio. That's a legalized bank robber. Yeah. So you have, conventional financing is not for everybody, especially for self-employed people. If you're self-employed or you have a hard time documenting your income, it's going to be very difficult to get a conventional loan. Okay, it's going to be very difficult to get a bank loan unless you have solid tax returns. So non-qualified mortgages, non-QM loans are the solution. They are the answer for the future for self-employed people. Because now self-employed people can get a mortgage with just using their bank statements or doing just asset-based lending where you put, a large down payment. You put 20% down and you don't have to disclose your income. Because if you can put 20 to 25% down, do you have to really verify your income? That's the argument that a lot of non-qualified mortgages lenders, they make. If the guy's putting 25% down, he's going to make his payments. He's got money. He might not be able to document all of his income because he has various sources of income. And there's a lot of people in the world that fit that bucket, that don't have a cookie cutter 9 to 5, W-2 paycheck. So they still need to get houses too. They still need loans. I have a lot of friends and colleagues, customers that are self-employed. They do various things. They make great income, but they can't even get a loan from their bank. Their bank will take their deposits, but they can't get a loan. Right? So, non-QM loans are a great solution, a great opportunity for self-employed, either for your primary residence or investment properties. And we're in the front, one of the pioneers at the helm of non-QM loans. We believe in those loans a lot. We think they're great. In fact, during COVID, the height of COVID, those loans had a better performance than FHA loans. People were making their payments more on non-QM loans than they were on FHA and conventional loans. So that shows you the power. If somebody's putting a large down payment, there's large equity in the property, they're going to make sure that that deal works out. They're going to figure out how to make the payment. They're not letting it go into default. Whereas a lot of FHA loans that have very little equity or very little skin in the game, if somebody loses their job, they may let the house go. But if someone's putting 20, 30% down, they're going to figure out how to make that deal work. They're going to get those payments made. So non-QM loans, that's now non-QM stands for non-qualified mortgage, the non-conventional loan. There's a marketplace for those type of products for certain type of people. Ideally, generally self-employed people. So it's a very, very good loan program for self-employed, and it's more asset-based and not so much credit-based and income verification-based, because sometimes it's hard to verify income. Yeah, there's a lot of people that are self-employed. I'm self-employed. I should make a video on non-QM. Yeah, I made a lot of videos on non, because I like non-QM loans. I think they're great. Because you should be able to get a loan with just using your bank statements. Or if I put large down payment, I don't have to show my tax returns. Why does it matter? If I can put a large down payment, then I don't need to show pay stubs or taxes. I should still get good terms. And that's the thinking behind non-QM loans. Now, there's still a verification. They still check stuff. We get an appraisal. We get a title. But the income is more lax than Fannie Mae, Freddie Mac conventional loans. Okay? Because, like I said, there's too many people some experts say it's not a good idea to pay off your mortgage. What do you think? I think, Don, I think that's a good question. I think it's subjective. Me personally, yeah, well, I mean, if you're asking me, no, I don't think so. I think to me, interest rates are so low. Use a mortgage to your advantage. If you look at, I think using debt to get rich is a great thing. That's my opinion. Use other people's money. Use debt to get rich. If you look at some of the richest companies in the world, they have tons of debt. But it's, you have to use the debt wisely, right? Use the debt wisely. So why would you want to pay off a mortgage? I mean, that's my thinking, when you can use the money to get higher returns somewhere else. Look at all these businesses. Look at Wells Fargo. I mean, take a look at the example of Steve Wynn Entertainment. If you look at his balance sheet, he's got billions in debt, and he's one of the richest people in the world. Okay, he didn't pay cash for those casinos to build those. He financed all that stuff. How much more is reasonable percentage? Tiny homes. Yeah, tiny homes. So how much? A couple questions are there. So how much would you pay over? It's all based on how bad you want the property, Jennifer. How bad do you want the house? I mean, because that's what it's going to come down to. What makes sense to you? I don't know. I think it's all relative to the person. If you want that, for example, I have some clients, they want to be in a certain school district, a certain area. They'll do whatever they have to do to get that house. They don't care. And you have some customers like, no, I'm not going to pay a penny over the appraisal. It's all based on you. I can't really tell you. I would never do it unless, my wife and I, or we made a collective decision that we had to have that house. I'm a value guy, so it's hard for me to pay more for something than what I think that it's worth. Okay, it's very hard for me to justify things that, okay, if it's worth $1 million, why am I paying $2 million or 1.1? I mean, why would I want to do that? I mean, it would be very hard for me to make sense of that. So you can take out a line of credit. That's right, Don. You can take out a line of credit on your house. Now, the other call, tiny homes, that is a great market, Bobby. I have seen a lot of demand for tiny homes. I just haven't seen the lenders really take an appetite to it or have that take off. But I think tiny homes are great. I think the tiny home market is very good. It's very strong. It's a great market. It just hasn't really taken off. A lot of people haven't taken a liking to it or started to appreciate tiny homes. But I think that in the next 10 to 20 years, that thinking will shift and more people will start doing tiny homes. Because, it can be very expensive to run and operate a big home. And a lot of people don't need a big home. They can have a small little home. Yeah, if you're willing to do it, Jennifer, then go for it. It's up to you. It's based on what you and your family decide. I can't really tell you because, there's too many variables. I mean, like if you have to be like, for example, where we live and we bought our house, we had to be in a certain school district for our kids, right? And so we were willing to pay a premium to be in a certain school district than not to be in another school district. So, I just, so we paid more for a house, I mean, than what if we went to a different neighborhood. Okay. So you see, so it depends. Now I have some clients that they won't do that. Like if the house appraised lower, they don't want. I think you and your family have to make that decision. I honestly do, because I don't know enough about what's going on to tell you for sure. I think it's all subjective. Because if you're going to stay in the house for a long time, inevitably you'll have value, right? So I think it's just based on what you decide. But anyway, these are very good topics. I'm glad that we talked about all of this today because they're huge things. And I love to educate people. We love to empower people. Remember, we produce a ton of great content on our show. We actually shoot 4 videos a week. Monday, Wednesday, Friday, Saturday, we release a new video. No debt, able to cover a small gap. Good. Cherries, I'm ready to go in the house, Angelo. Want government to raise, they said that. Okay, you might want to look, Cherry is a good idea, a good program that you might want to look to is USDA Direct. USDA Direct has government loans to help people to get you a very low payment with like basically no interest. Like maybe 0% or 1% interest to buy a house. Look at USDA Direct. Great program to help. Well, we talked about some very important things tonight, guys, that's going on in real estate, going on with mortgage finance in America. So some of the takeaways we talked about, non-QM loans in the future with America. We talked about locking versus floating. That's a huge topic, right? We talked about waiving financing contingencies. Should you do that? And the answer is no. We talked about transferring jobs, what to know, what to think about when transferring jobs. These are important topics. And we talked about a bunch of other stuff too, first-time buyer, military income, self-employed. So these are really, really important things. And remember, if you guys need any type of funding, we have commercial, residential, private lending. We're nationwide. Call or text our office at 832-431-633. We'd love to hear from you, love to help you with any type of loan financing, any type of structured loans that we can get to you. Please reach out to Angelo Christian. We do, every Thursday, 7 p.m. Central, we do a talk live with Angelo. You get to connect with me. So get encouraged. Don't get sad. Get encouraged. That's right, Bobby. I love that. That's always a great saying that you have. I love that. So, every Thursday, 7 p.m. Central, talk with Angelo. We're always here for you. We've been doing this for over 20 years, helping, tens of thousands of people. Thank you, Sandra. I really appreciate all of you guys watching the show. And I do want to end with our giveaway for Amazon. So I'm going to ask you a bonus question. And whoever answers it first, the best, I'm going to say first and to the best of their ability, is going to get, we did talk about HELOCs too. So I do want to ask, so the question I have tonight, and whoever answers it first, the best, is going to win the $100 Amazon gift card. So you have to answer it first, and whoever answers it the best answer. So the question is, to end the night, is tell me 3 of the top benefits of a HELOC. Go. So name me 3 of the top benefits of a HELOC that we talked about tonight. What are the 3 top benefits of a HELOC? So whoever answers that the best and first is going to win the $100 Amazon gift card. So what are some of the benefits that we talked about, the 3 top benefits of a HELOC loan? So who can answer that first is going to win the $100 Amazon gift card. Who is listening during the show to get the $100 Amazon gift card? Some people were listening, some people were not listening. So what do we talk about tonight? The 3 benefits. You got here late? Well, we have a lot of videos on HELOCs. So somebody has to be able to answer flexible terms. Okay, there you go, Anthony. Okay, Anthony got it first. Anthony was paying attention. Wanda, you were close, but Anthony got it first. Congratulations, Anthony. You won, man. So text me your email address, buddy. Text me your email address to 832-431-6331. You won the $100 Amazon gift card. You paid attention. 90% interest only. No escrows. Good job, Wanda. You're right behind him, but Anthony just got a little bit faster. So just text me your email address, brother. We'll take care of you guys. Thank you so much for watching Angelo Christian. Please watch the channel, Angelo Christian Mortgage, on YouTube, official Angelo Christian on Instagram, Facebook. We're here for you guys. Take care. We love you guys. Max out. Make the most of yourself. I'll see you guys next Thursday. Take care. Bye-bye.